Moving over to vol, realized vol did take a hit back down into the 30s on BTC. That's the yellow line dropping like a stone there. Implieds, though, you can see we're flatlining. So implieds are flatline whilst realized has dropped. What's that done? It's jacked up the carry to over 10 vols, basically. Ethereum realized also dropping, but only about 5 vols down to around 40. Implieds staying pretty flat. So we're generally seeing spot came lower, vols just didn't budge, realized actually didn't spike and came lower, but we've got a bunch of catalysts like non-farm payrolls, like CPI and the FOMC. And all those things are potential market movers on macro, and therefore crypto's not going to ignore it, or the market's going to perceive at least that crypto can move on this. So they're going to hold that implied vol higher for some of that event risk, which is why you've got positive carry in both Ethereum and Bitcoin in the order of magnitude of around 10 vol points. Those key supports, though, if they were to break 21k and 1450, that's when you might get a real move, because if we then start to accelerate to the downside and volatility comes back, then there's a bit of a shift in market sentiment. It might induce a load more put buying because people see a lot more downside after that break and things can shift. But until that level is broken, we are in this kind of status quo where realize is remaining low. Okay. Looking at term structure, not a lot going on in term structure, pretty much staying the same. You can see week on week, those curves are almost identical, still in contango. The vol spread is pretty stable as well, parked at between 5 to 7 vols, 5 to 6 vols, something like that across the entire list of maturities. That green line is pretty flat there. Realized on the 30-day metric is closer to 3. The spread, and realized on the 10 days closer to 7. So the implied is bang in the middle of the 10-day and 30-day realized, so pretty fairly priced. Obviously, you look at the chart, we know it's cheap. We've been flagging that the spread down here at 5 vols is a pretty decent entry point, just based on historics and where these things typically trade. And we could easily see this go back into the 10 to 15 range at some point when Ethereum comes alive, like we know it loves to over time. Right, it's just a question of what is the catalyst that's going to spark that. It's pretty likely there will be one. We just don't know when it is exactly, which is why we park ourselves in September expiry. Gives us plenty of time for that mean reversion to occur, for implied vols to go back to levels that are more normal in terms of the spread. Now, the positioning set up in Ethereum has been dealers long, particularly in March expiry, which is why it's been struggling to move, I would say, and why the realized differential has been so small between the two indices. Maybe that's just because the street is long a load of March. When that March optionality expires in 3 weeks, then does that free up Ethereum to start moving again? It depends if we get fresh supply in April and June, maybe we will, but that might be what's really making ETH struggle. Lack of catalyst plus general long volatility positions in the dealer community. That might be what's kind of creating that condition. If we look at SKEW, short-dated SKEW remains in favor of puts. In BTC, spot obviously heading lower into the 21 area, 22 area. So it's a little bit of a bid coming back for short-dated puts. ETH SKEW is around 2 to 3 vols more expensive in terms of puts than Bitcoin, particularly in the front end of the curve. And that has been a consistent pattern lately where ETH puts have been trading above. And that's why you can see this yellow line above the green on the 1 month and the 3 month maturities. Longer dated SKEW looks a bit different. You've got a bid for calls on BTC. So 6 month BTC is at 2 vol premium for calls. Ethereum, though, put SKEW is flatter as you go further out. So whilst you've still got a very slight put SKEW, it's closer to neutral as you go further out. So in general, the whole crypto space applying a bit more bullish sentiment for longer dated SKEW, but Ethereum is still got a put premium in the back, whereas Bitcoin's got a slight call premium in the back. And in general, we do think selling Ethereum put SKEW for those who want to get into Ethereum at lower strike prices because it's a deflationary asset these days makes sense. And then for BTC, for those who own it from a long only type perspective, doing risk reversals in the long end looks attractive because you're getting rid of those calls at a higher vol than the vol on the put side that you're selling. And in terms of the moneyness of that, it sets up really well because for long dated options on a high implied vol, the way the delta of those options works you end up selling a very far out of the money call to get yourself some put protection, basically, right? So we like that structurally as a good way of hedging longer dated holdings in BTC. Okay, nothing really to say on the individual dashboards. You can check those out in your own time. Looking at option flows in BTC, those volumes have decreased week on week as spot grinds lower. Typically, we're seeing correlation between bullish price action and flows. Put protection buying did come in. 22K to 20K strikes were the flavor of the day in terms, and in the short dated between 10th of March and 28th of April. We did also see put spreads as well. Short dated call selling also in the 22.5 to 23K zone. So that this area here. So as we did break down, people were selling calls to fund protection as well, just dumping calls that they had bought because they lost faith in them. We saw a bearish risk reversal in March, 20K to 25K in big size. That's these big blue bars here. That's one of the bigger clips. We saw a June bullish risk reversal where they sold the 20K puts in June to buy the 30K puts, 30K calls. And that was a smaller size than the March, but interesting to see how you've got the bearish plays in the short end in terms of trading the SKEW to do that trade, but then flipping it the other way around for June, basically. And that is the kind of mentality that's going on, right? People would rather do those longer dated bullish plays. Dip buyers using the call spreads in April, the 26K, 28K call spread. And then there was some upside convexity being bought by people selling June 23 and Sep 23, selling things like the 24K area or the 28 to 30K area to then buy these higher strikes, which are way out of the money, but basically just saying if we got this massive re-rating higher at some point this year, then you'll kick into a load of Vega and the vols can re-rate and explode, basically. So people trying to do the volar play and own those wings because they think those wings are trading relatively cheap compared to where they can go if we start to move. All right, in terms of ETH flows, not a whole ton going on. I mean, there's some really big clips in these calendars. So you had the March, April calendars and the March, May calendars getting sold. So buying the 1700 and 1800 in March, which are these green blobs, to sell April and May in the 1800 strike. Okay, so that looks like a short Vega trade with a bit of gamma protection, basically. That's kind of what it looks like. So if you think that vols are going to continue trending lower, but you're not comfortable being short a load of gamma around the events between now and end of March, because they're quite big events, then that's the type of trade you might do, basically. But those flows pretty much overwhelmed all of the others. You look at the sizes, we're talking like 50,000 options to 80,000 options, right? So it's quite a chunk going on there. But we did see put and put spread buying in the 1500 to 1100 strike zone here. And that was similar to some of that put action that we saw in Bitcoin as things broke down, but the things haven't really accelerated, right? So nothing too untoward there. Okay, if we look at positioning, we've got positioning flipping towards neutral. So Bitcoin dealer gamma goes small long as these 10th of March calls get sold. So we mentioned the call selling flow. So you can see here, the orange is the 10th of March. 10th of March, you've got a load of longs coming up on the 22.5 and 23.5K strikes. And that has supplied the street with a load of gamma, which is why we've seen a move up here into positioning closer to zero line for Bitcoin gamma, right? So dealers are no longer short a ton of gamma. In fact, they're quite neutral and they're not going to get short unless we were to go into this zone up above 26K, which feels pretty damn far away right now. Okay, and also between now and then, we would see flows come in to potentially change the picture as well. In terms of Ethereum dealer gamma, longs are stable. We've been in the long gamma territory for a while now. That hasn't really changed. Realize is obviously reflecting that. Can't really move too far. Spot really struggling. Ethereum dealers are long vol from the 1500 to the 1800 area, as you see here. And that's kind of holding the market range bound if we don't get a major catalyst to break it free, right? So obviously, if we got a catalyst and we started to rally, then someone might come in and buy a load of March and take dealers out of this exposure. But what would probably happen is because dealers are long it, they would happily supply it and you wouldn't see a material move in implied vol unless the flow that came in overwhelmed that positioning and took the dealers short. But I think we're a fair way away from that right now. And you can kind of see that in the kind of boring realized vol that we're seeing with realized down at 40 vol in Ethereum. Okay, so that's positioning. What have I been up to? That's it for this week's Crypto Weekly. So thanks again for listening, and I'll catch you all next week. Cheers.